What's up guys, it's Chris here, and after a crazy year, here we are in 2023. So as usual, we'll be setting our investment goals, and as we always do, try to select what will be the best investments that will help us grow our portfolio and our personal wealth. So in today's episode, I'll be taking you through my 5 top stock picks for 2023 that I'll be investing in and go through exactly why I think they are good options to buy. And at the end of the video, I'll be showing you a very interesting way how to invest in all of them, and I'll be investing in them right here, live and in real time. This is going to be a great one, so let's get started. Okay, so in quite a few videos we've been through our recap of 2021 and why the markets behaved like they did. So if you haven't seen that already, here's a quick recap. There were 5 major events that happened which affected our markets, and those things were COVID, the war in Ukraine, high inflation, rising interest rates, cost of living increases, and a technical recession. Now, because of those 6 things, the S&P 500, which is often seen as the best market indicator, went down 19.4% in the year, making it the worst year for the market since 2008 and the 4th worst year since the index started 65 years ago. But right now we're in a new year and we need to start thinking about what to expect for 2023 and what that means for our investments, and more especially which stocks we think might make some good profits for this year and beyond. First thing is first, last year we saw everything rising. Inflation went up, interest rates went up, fuel prices went up, cost of living went up, layoffs went up, unemployment went up, and also load shedding went up. And because of all of that, the only thing that didn't go up was the market. But what goes up must come down, and while no single person has a crystal ball, a lot of market analysts have said that 2023 might be the year that these inflationary pressures start coming down. There's a great article from JP Morgan that lays out in detail their outlook for the markets in 2023. There's a lot of detail, but the bullet points come down to this. They have said the global economy is expected to expand at a sluggish pace of 1.6%, that the global economy may not slide into recession, but that a recession for the US market is likely during this year. But this last part is most important. They have said that the beginning of the year should show more negative movements, but that if the Federal Reserve Bank starts slowing or reversing interest rate hikes and inflation slows or starts dropping, that this may trigger an asset recovery later in the year for the S&P 500 to reach 4,200, which is about 6% higher than now. So for me personally, that means something very important. This could very well be the last year that we experience these low stock prices before they start moving back up. So if we can invest consistently during the year, dollar cost averaging into the markets, even and especially if the market continues to go down, then it's the last chance for a while that we can buy so low and make above average gains. Again, no one has a crystal ball, but that's my plan. So with that in mind, we're going to look at these companies that have solid fundamentals and historical growth, but some big drops over the last year in a high inflation environment. Because if these pressures start easing, then their growth and share price might begin to rise as well. But remember, these are the companies that I'm looking at, so be sure to do your own research before investing to decide if they are the right ones for you or not. So without further delay, let's jump right into it. The first company that we'll be looking to invest in for 2023 is Apple. As you'll see, many of the companies that were hit hard last year were large technology companies. This was because of a combination of reduced demand from the height of the lockdowns when everyone was using tech companies, to the interest rate hikes of 2022, and they had to deal with reduced sales of products and higher payments on their debt. Most technology companies have higher levels of debt because they use it to rapidly expand. Apple, for example, has nearly $100 billion of debt, but on top of that, from January last year to now, the share has dropped from 179 to 137, which is a 23% drop, nearly a quarter of its value. But as you can see, over the long term, the company, as we know, has had tremendous growth, and in the last year, its revenue and net income has been growing. Now, the lower the PE ratio, the better value the stock, and right now, Apple has a PE ratio of 22, down from a high of 35 1 year ago. So its PE ratio is lower than its peers. Analysts say that it's 17% undervalued, with growing earnings and an expected rise in price within the medium term of 22%. Next up is Microsoft. After losing 28% last year, it seems to be at much more of a fair value, but with forecasted earnings growth of 14% a year and a PE ratio of 25, better than expected at 47, analysts forecast stock price growth of 21% in the medium term, and with a general dividend of just over 1%, the share has a small but pleasantly surprising passive income. Overall, it's a well-positioned company, especially when you consider its low debt ratio, with the company earning more interest on its cash than it pays interest on its debt. But if you want to talk about low debt ratios, we have to talk about our third share, Alphabet. For those who don't know, Alphabet is the name of the holding company for Google. So if you're investing in Alphabet, you are essentially investing in Google. Now, when I was looking through all the potential shares to buy in 2023, I've got to say that Alphabet has got a fact sheet like few others. Just that it's a very responsibly run and well-profitable company. When they made their original motto, which was "Don't be evil," it applied to how they run their books as well. Let's take a look here. First of all, it's trading at a 35% discount with earnings forecast to grow at 12%, good value compared to its competitors, and analysts anticipating a 28% share price growth in the medium term. But check this out, absolutely no risk detected on its balance sheet, all of its valuation metrics are green and positive, and its PE ratio of only 19, our lowest and therefore best so far with a fair PE of 30. All of the metrics when you analyze it point to good governance, plenty cash flow and growth in the future. Just look at how small their debt is compared to its assets. Incredible. Now, with a share decline in the last year of 32% and seemingly good future growth, this company seems like good value, but there is something to remember before investing that we will touch on at the end of the list. Next up is Amazon. Now this one is a bit of a riskier investment and I'll tell you why. The first thing is to look at the PE ratio. Now remember again that high PE ratios usually are bad and low PE ratios are good, and Amazon is very high at an 89 PE ratio, but I guess it's only relative to when it was trading at a PE ratio of 171 last year. So compared to that, it's a bargain. Look, Amazon is a company that is in many ways expected to take over the world, between its online stores and deliveries to a streaming platform to how fast it's expanding, including to South Africa. It has a high premium because high growth is expected in the long term. Think of a macro store but for the whole world. And because it has had a drop of 47% in share price last year, it seems for many to be at a good value, with analysts saying it's trading at 49% lower than its fair value, with earnings growth forecast at 45% a year. While it's low, maybe this is one share to get in on. And lastly, we're going to switch gears ever so slightly to United Health Group. This is the biggest health group services on the planet and the 7th largest company by revenue in the entire world. Not only that, healthcare is an industry that's been growing and is expected to be one of the highest growing, if not top growth sector in 2023, and United Health Group is the largest with some strong fundamentals. This was a company that grew 6% last year and seems to continue this in 2023. Even with that growth, it appears to be trading below its fair value, with further earnings growth forecasted, a larger but decent debt level, and if that's not enough, there is also an extra cherry on top with a dividend of 1.3% that is set to grow in value along with its earnings. This share appears to have less risk, a solid track record of share price growth and returns, and in an industry poised to be the largest growing of the year. And that is it. Those are the 5 companies that I'll be buying into in 2023. But remember, there was something I needed to tell you. Well, here it is. Keep in mind that there is no guarantee these shares won't drop further this year, and I'm very much prepared for that. It's almost impossible to predict the bottom, and we may go down further before we get there. But my plan is to keep buying in while it goes down, and especially if it does, and make my money when it goes back up, and look to make larger than normal returns in the medium to long term. So like I promised, we are going to buy into these companies live and in real time, but we're going to do it a bit differently because we are going to be buying into these shares through an ETF, specifically the Vanguard S&P 500 Growth ETF. If you take a look here, you will see that the 5 companies we mentioned are all part of their largest holdings, along with some other smaller companies that will help us diversify our risk and keep our investment into these growth companies all in one place. This ETF specializes in high growth companies that were hit hard in 2022 and in my opinion are positioned to make some extra large gains because of that in the long term. So instead of putting smaller amounts into each of the stocks, we can pool our money into one investment, which also includes some of the lesser known shares and diversifies our risk, all the while still paying us dividends of just over 1% a year. So it makes it much easier to invest, reduces risk, and includes some potential higher growth from the smaller companies as well. So let's head into EasyEquities, where we are going to first do our foreign exchange transfer from rands to US dollars. Then once it's received, we're going to go to invest now and search for VOOG, the ticker symbol, and then we're going to go down and we're going to invest an initial amount of $111 or 1,880 Rand, and we're going to continue to top that up throughout the year. And guys, that is it for today's video, where we pick our 5 favorite stocks for 2023 and invest in them all live and in real time through an ETF. If you enjoyed the video, please be sure to leave a like. And if you want to see how this investment does and to follow all of our investments, portfolio and news for this year, please feel free to subscribe to the channel. But until then, I will see you next time, as always, on Casual Cash. Cheers.